Look over here. Don't look over here. Look into the watch. Look into my eyes. Is that what's going on right now? I think we've all been paying too much attention to what's been going on with AMC stock, GameStop stock, the big short squeezes, what happened with the hedge funds, Wall Street Bets, Reddit, and Robinhood. And we took our eyes off the overall stock market, and I think that was a mistake. Are we in the beginning stages of a stock market correction, a stock market crash, if you want to call it that? What's good, all my trader and investor homies? It's your boy Kevin. This is Touchdown Trades, the home of the #1 stock market trading and investing channel on all of YouTube. In today's video, we're going to be talking about whether we are in the beginning stages of a stock market correction, a contraction in the overall economy, and are we seeing the big hedge funds, the hedge funds that just got crushed in the GameStop short squeeze, are they pulling their money out of the market? Are they pulling the rug out from under the market? And are we seeing what could be the beginning stages of a stock market crash, correction, contraction, pullback, whatever you want to call it? The stock market came off the highs by a good bit last week, but nobody was talking about it because everybody was focused on the big drama. But I think we need to take a step back and revisit what happened in the overall stock market last week. Take a look at some of the biggest stocks in the market and take a look at their valuations. Are things getting a little bit out ahead of themselves and need to kind of settle back down, let the dust settle? I think maybe so. So if you're new to the channel, hit that subscribe button and turn on the notifications, and everybody go down there and like that button. Just start clicking all the buttons. And if you want to get 4 free stocks, free money valued up to $3,700, check out the link in the description for Webull. It's a max exodus of Robinhood, and I don't blame you. And Webull is my preferred broker. They've partnered up with Touchdown Trades to give you guys 4 free stocks. Find that link down there. Also, if you want to come trade with me in the private Discord chat and alerts where you get my buy and sell orders in real time, there's a free trial down there, link down there as well. Check it out. All right, let's break down whether we're about to see a stock market correction in the coming weeks. Let's get it. Last week, everybody was focused on GameStop stock, AMC stock, what was happening with Wall Street Bets and Reddit, and Robinhood pulling the biggest chicken move of all time and bowing down to the suits. But while that was happening, something else big was happening in the overall stock market. But who can blame the retail traders and investors? It's not every day we see a crazy event like this GameStop short squeeze from under $20 a share, boom, to the moon. But we need to take a step back. We need to revisit what happened in the S&P 500, what happened in the overall stock market last week. Because it was just chugga, 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 choo, choo, all the way up. We were on a steady uptrend. We were headed higher. It seemed like there was no end in sight for the overall stock market. There was no pullback coming. And while we all had our eyes on GameStop and AMC, we had this pullback from the almost 390 area, 387 or so, down all the way down to under 370 a share. So that's a pretty significant pullback. And any other week, that would be the talk of the town. That would be the talk of the market. It would be on CNBC, Fox Business. But because of what was going on, nobody's talking about it. So today we're going to be talking about whether this is the start of a correction. We're also going to be looking at the numbers of some of the biggest stocks in the market, your Apples, your Teslas, your Facebooks, some of the big blue chip stocks, the leaders in the market, because everybody follows the leader, right? And once they start to pull back, it's a domino effect. So I think their valuations are getting a little bit spicy, a little bit up there. So we're going to take a look at those as well. All right, so let's jump right into it. Let's get it. Just a couple days ago, I read this article published by Goldman Sachs warning of a dangerous bubble in a bunch of popular stocks. Basically, Sachs ran the report saying that this list of 39 companies with some big popular names on there including Snowflake, Zoom, Shopify, Fastly, Slack Technologies, and a bunch of other big companies were trading at extremely high enterprise value to sales ratio, which basically measures how much it would cost to take over a company based on the company's sales. So they were saying that the normal stock in the S&P 500 trades at this ratio of 4x, while these stocks are trading at 29x, which is extremely high. It's an extremely high ratio. Apple stock, a leader in the market, is trading at its highest price to earnings ratio, which measures a company's market cap compared to the company's earnings of all time. So Apple is not really thought of as a growth company. I guess there is still some growth story entrenched in Apple stock, but not really. It's not thought of as a huge growth name like Tesla, something like that. Apple's pretty much seen its huge growth. Still, it's a great company. I'm not saying Apple's a bad investment. What I am saying is when we start getting stocks trading at these valuation, there is a little to no room for mistake. And if we start seeing quarterly earnings reports coming out, missing the number by barely anything, or even if they match the number that was expected. So let's say Apple comes out with their next quarterly earnings report and they match the Wall Street's expected earning numbers, the revenue numbers. I don't think that's good enough. I just don't think that's good enough when we're trading at these valuations. And that goes for every single stock out there right now. Look what happened to Tesla when Tesla reported a really nice quarter. Tesla reported a really nice quarter just a couple weeks ago, and the stock ended up gapping down about 5%, I believe. And they're off the highs by as much as 10 to 15%. So I'm not saying Tesla stock's going to crash. I'm not saying Apple stock's going to crash. What I am saying is that we're trading at extremely high valuations, and there is no margin for error. If these companies start coming out with earnings reports that are any way, shape, or form off the number at all, we are going to see a correction in those names. And that doesn't go for any one stock. That goes for the entire market. Tesla reported earnings back here, trading at $890 a share. So the day of earnings, came out with a really nice earnings report. Elon said that they expect to have 50% growth on deliveries year over year for the foreseeable future. That's a crazy number, 50% growth, but it wasn't good enough. The stock still gapped down about 5%. We're still trading below that gap, and I'm not sure we get above that gap before getting a retest of this 720 area. And that's not a knock on Tesla. That's a knock at us trading at these levels. And I think the hedge funds, the big money, used the distraction of GameStop AMC to kind of peel some profit off, take some off the table. And we saw that with the sell-off down to from 385 down to 368. So it wasn't a huge sell-off, but once the wheels start turning, there's an old saying, the bulls take the stairs up, and we can see that here, just a slow, steady grind up, and the bears, they take the window down. And that's where you see just the sharp contractions in the market. And it holds true. Slow, steady grind up, and then we get the bears coming in, and we jump out the window. Slow, steady grind up, jump out the window. Slow, steady grind up. Are we about to jump out the window? That is the big question mark. And I can't give you an answer. I'm not here to speculate. I just wanted to draw attention to the fact that we're trading at extreme valuations. Tesla has a price to earnings ratio right now over 1,000 and a forward PE after posting 4 really nice quarters in a row, or 5 really nice quarters in a row now. And they still have a forward PE of over 150, which is extremely high. Apple, let's take a look at Apple. I'm just focusing on a couple of the big blue chip names out there. Apple has a forward price to earnings ratio of almost 30. And this is not a growth company. Tesla, you can justify it by saying Tesla is a growth stock. You can't really say that for Apple. Let's take a look at Facebook. Facebook has a price to earnings ratio of 20. These are high valuations, guys. These are not valuations that you see every day. And that's something that we need to be aware of in our investing. So one thing I'm doing more actively now is swing trading. I pulled some of my money out of my long-term investments. I've taken some profit off the table. What that allows me to do is keep cash on the sidelines while still being invested in shorter term swing trades. This helps me feel like I'm less at risk. I know what my risk is when I'm entering the trade, and it helps me keep some cash ready if there is a pullback, if there is a short-term crash. And it gets even better if we take a look at the M1 money supply. The Fed has just been printing money like it's nothing, like there's infinite money out there, no joke. We see the steady supply. This is the M1 money supply. It measures the amount of cash out there right now. And we can see that just slowly, steady. We hit 2020, and then boom, to the moon went the cash. I didn't see much of that cash. I guess it was the stimulus checks that this is accounting for. But when you see an increase of money like that, that is not a good thing, and it cannot be good for the overall direction in the stock market. And I just think there's going to be another stimulus check. This chart is going to look even more ridiculous. The Fed has to slow down. They got to put interest rates back on sometime. And the answer of whether there's going to be a stock market crash, if it's going to happen, is very simple. The equation is very simple in my opinion. Number one, is there going to be more stimulus in the near future? Probably so. Number two, is the Fed going to raise interest rates in the near future? Probably not. So we're having the stock market propped up by the Fed, by more stimulus being injected into the stock market. Sure, that may be a good thing for the short term. We can maintain these levels for the short term, but for the long term, I think it's a tragedy. I think it's going to be really bad, because at some point the Fed is going to have to raise interest rates. It's healthy. It's healthy for interest rates to be out there. It keeps the value of the dollar stable. It's good. Interest rates are good. But once we've had years and years of no interest rates, if the Fed raises interest rates, it is going to shock the market, and I think it could be really bad for a couple of months, maybe even a year or so, once interest rates are risen. That's why I've moved some of my money out of my longer term investments. I'm still heavily invested, but I'm focusing a little more on swing trading and more active shorter term trades. And I didn't make this video to try to scare anybody. It's not one of those clickbait thumbnail BS that you see other finance YouTubers make. I'm really worried about the direction of the stock market. All right, guys, just wanted to get that out there. I love every single one of you. Thanks for hitting that subscribe button. Check out the links in the description. I'll catch you guys in the next one. Until next time, peace.
Drop.